Good afternoon, ladies and gentlemen. This is Robert Rayburn here at Life Pro Asset Management. Thank you for attending this week's stock market update. And I hope that everyone had a fantastic long weekend. Now, given that it's only been 2 or 3 business days since our last update, we wanted to take this week as a unique opportunity to review our long-term energy investment thesis. We are so excited by what's in store for the energy sector over the next 2, 3, 4 years and beyond, that we wanted to share it in detail with everybody, both from a supply perspective, what's going on in terms of future oil supply, but also on the demand side, because we know that's where we get a lot of questions as it relates to electric cars and the potential disruption to energy demand over the long run. So, when we think of the oil market, really there's 2 ways to sort of drive up the price of oil. One is through massive demand that overwhelms supply, and the other is through incrementally lower supply. In other words, you don't need that much demand to send prices upward and to the right. And so what we've seen here over the last few years is the rise of the ESG movement, the green movement, has really started to restrict capital investment in the very important oil and gas space. So when we think of today's presentation, there's really 3 key points that we want to hammer home to our clients and advisors and anyone else that's watching this presentation. First, we are on the cusp of entering what we call the post-shale era in the energy space. That level of overall supply growth, production growth in shale is slowing and reverting downward. U.S. has been the big key swing supplier over the last decade. 2, demand is set to grow despite the rise of electric vehicles. We know that most people believe that it's going to completely send oil to the floor because no one will use oil. We're going to debunk that theory today. And then lastly, we're approaching peak supply, not peak demand. And we'll go through all of these points in detail. So what are the ingredients of this energy bull market? Over the next 10 to 15 years, we are expecting demand growth in around the area of 20 million barrels. In other words, between now and 2035, an additional 20 million barrels of oil on top of today's base load will be consumed on an annual basis here, not on an annual basis, sorry, but total growth of 20 million barrels between now and 2035. Global capital investment continues to plummet across the space. Remember, to bring new wells online, whether it's onshore or offshore, we need money. We need to invest in those projects early on so they can bring that supply on in the future to meet rising demand. Global offshore production has been in secular stagnation and decline for many years now. Shale in the U.S. has only masked the problem. So as shale starts to top out and peak, as we see there on point 4, a lot of these problems are going to come to the surface. And then lastly, all of OPEC's spare capacity, regardless if we bring Iran into the picture or not, is projected to be spent up by 2022. So what's the basic Econ 101 message here? Demand is growing and we got flat supply over the next 10 years. What happens next? Does oil go up in price or down in price? Well, in our opinion, that price is going to go up. So let's have a quick chat here about demand. So we know everyone's core bear thesis in energy is that everyone's going to drive a Tesla and a Prius and no one's going to go to the gas pump to use oil anymore or gasoline anymore. Well, let's go through that scenario. So in the chart here on the left, what we see is by 2050, if we assume 85% of cars, sorry, 90% of cars are converted to electric. In other words, basically 100%, but in stats we'll do under 100%, 90% conversion to electric cars plus 55% conversion to fuel cell trucks, just because fuel cells are still kind of earlier stage technology than some of the battery technology we see with individual vehicles. what we see is that demand for oil, despite this 90% conversion to electric vehicles, is set to grow by 20 million barrels by 2035. Now, you may ask yourself, how on earth is that possibly true? Well, let's go through the different uses for oil. Cars and trucks, obviously a huge component of demand. But what people don't realize is that diesel demand and petrochemical demand are even larger uses of oil. And as the third world continues to develop and demand for plastic materials goes up and other petrochemical industries start up and continue to use products that use oil, if you sit at a desk, if you sit on a chair, guess what? All of that uses oil. So what we see here is that this light green line here is compressing and flattening out and declining as more and more cars are using electric batteries. But notice what's not declining is petrochemical, this space here on the in red, and then of course diesel demand and jet fuel demand. All three of these categories are actually set to rise, which is going to push up the demand for oil, while supply, as we'll see here in a bit, is not able to respond. So this is the big demand picture that we talk about. Even though we actually think that the ultimate electrification of cars is going to be a much longer process, even if we get 90% conversion to electric, oil demand set to rise by 20 million barrels. Meanwhile, here in the short term, oil inventories are plummeting. I pulled this chart from my Bloomberg terminal today, so it hasn't been manipulated in any way to kind of screw around with timelines or anything like that. That's as of today. Oil inventories are plummeting. What we see here is the year-over-year global surplus in oil, both onshore and offshore, has gone from severe surplus to now a deficit. So in other words, it only takes a small demand increase at these levels to light the match for the price of oil. So then we look at, are we at peak supply? So let's look at ex-US. What we see here is capital spending has plummeted, both here in the US, across North America, and internationally. Why is that? When we get the green movement or ESG activists that make their way onto boards, such as Chevron that we've seen recently, or Exxon, or Royal Dutch Shell, the first thing they're doing is forcing these companies to cut spending on carbon-based projects and reinvest their profits into green energy. The problem is that green energy and the technology around storage and redistribution of that energy doesn't exist yet. And we're still using a lot of oil, right? So if we're using a ton of oil in the petrochemical space around plastics and consumer products, how are we going to meet that rising demand? The problem here is that the amount of investment, capital investment in the space is plummeting. And we're already starting to see it with non-OPEC production, whether it's across Brazil, Canada, US is now starting to face offshore production across the world. That production is starting to decline. This is a momentous moment in the energy market, and one that is set to light the match for a long-term secular bull market in this space. The era of shale is waning. Over the last few years, we've had this massive bull market from starting in 2010 all the way to about 2018, where we saw huge supply growth, which killed the oil market, the price of oil. That is now going into decline. This is the production of oil and natural gas here in the US. It is declining. And not only that, the amount of reinvestment in the space is declining. Why? Because CEOs are now being compensated based on return on invested capital, not on production growth. And a lot of the production growth in the past few years has been uneconomic. In other words, companies were losing money, but since the CEOs made money based on production, they did it. Now it's based on return on invested capital, and we're seeing the results of that today. Also, price is not incentivizing that production, right? So a lot of people say, yeah, but when the price rises, production will come online. But notice what's happened. As oil has gone from $20 a barrel to 70, production has stayed low. Rig counts have stayed at a generally low level. the amount of cash flow that we see here on the bottom left chart that is being plowed back into the company to increase production is at a record low rate. In other words, only about 45% of positive free cash flow is being reinvested back into that company. So historically speaking, when oil was sitting at $60, $65, $70 a barrel, this was the overall rig count in the US. We can see obviously rig counts go up with the price, but this is where we're at today, the red dot. The red dot shows that even though the price is at $70 a barrel, those rig counts are at secular low levels relative to price. So as US production is falling as companies are allowing profits to fall into that retained earnings account. So this means more dividends, more stock buybacks, but most importantly, supply constraints across the world. So this chart here shows shale production growth. This was the shale revolution in the US. Massive amount, changed the global game in terms of oil production, made the US the global leader in oil production. Before the shale revolution took place, the price of oil in the prior 10 years, or sorry, the prior 5 years had averaged was $73 a barrel. We're already at $70 a barrel. How is that possible with all this production? Because of demand. China, India, Indonesia, all of the emerging markets, all of that demand that has been rising over the last 15 years. So at $70 a barrel, we now have shale production growth falling. Imagine what happens if this continues to fall and where that price of oil will be if we have this production. That is the game, ladies and gentlemen. That is the secular growth game. Everyone's in technology, and we were too for 10 years. This is the opportunity now, because this is where no one's invested, where the fundamentals are the most attractive. We see there with OPEC's spare capacity. Right now, about 2.3 million barrels a day of spare capacity with OPEC when you don't include Iran, and then an additional 1.3 if you include Iran. Oil demand is growing about 1.5 million barrels per year right now. So all of the spare capacity without Iran is used up by next year, with Iran by the end of next year or the beginning of 2023. So how are we going to be able to respond? There's no supply to meet that rising demand, and the market will start to pick that up as a generational game, as the restart of the commodity cycle. And by the way, all that green technology is massively consuming copper. We're set for a structural copper shortfall over the next decade. Now, in the short term, oil's been weak. Why? Because of COVID. As we know, investors have used oil futures to communicate their uncertainty over COVID. The financial market is much larger than the physical market, but long term, the physical market always wins. We see that 10-year yield, WTI, went down because of COVID. Those COVID cases are declining now, and we're starting to see stability return to the oil market. Oil going from $62 a barrel to $70 a barrel. And these companies are dirt cheap, by the way. All these energy stocks are dirt cheap, trading at close to anywhere from 2.5 times to 5 times multiples. That's incredibly cheap. We don't even have to go back to the 7 to 9 time EV to cash flow multiples to have these stocks double. Now, we're using Canadian stocks, Canadian energy stocks as an example here, because we don't want our biases impacting our US investments. But even if we take a look at these Canadian stocks, these Canadian energy stocks, if they just go to 4 to 6 times, 4 to 6 times EV to cash flow, these stocks are doubles. In other words, the amount of cash flow that these companies are generating would allow, on average, for these companies to buy all of their outstanding stock and debt back over a 7-year time period. That's insane. That's incredible. That's how cash flow rich these companies are right now. They can literally, in 7.5 years, buy back all their outstanding stock, pay back all their debt, and be a completely private company just based on their annual cash flows. So again, we look at these charts: tech or energy, financials or healthcare. When we look at these long-term cycle charts, remember, we are long-term cycle investors trying to understand those 10 to 20-year cycle themes. Which of these charts do you want to buy and which of these charts do you want to sell? We leave that up to you. So overall, the oil market is potentially entering into a multi-year secular bull market. Don't come in and buy these stocks after they've gone up 50, 60, 70%. Buy them today. Now is the time to invest in them. They're cheap, they're printing money, and they're set up for a multi-year run. Now is the time to invest. We could not be more excited about this space. The fundamentals are absolutely fantastic. They're the most attractive of any sector in the market based on our work. So the message here, supply is peaking out across the globe and demand is set to grow by 20 million barrels per day if our research is correct, despite electric cars. So if anyone has any questions on our energy thesis, please feel free to reach out to your advisor or reach out to us at 888-543-3776. You can also reach me out on my cell phone at 858-354-5114. Thank you again for all of your business and for all of your guidance. And if anyone has any questions, please feel free to reach out. Thank you again and have a fantastic weekend.